Great. So again, this is Ben Johnson. See, he looks exactly like the picture. I'm going to turn it over to you and go ahead and take it away. And then at the end, we'll go through some questions.
Okay. Mike, can you just see the PowerPoint slide, or can you see some of the other controls on the right side of the screen as well?
Just a PowerPoint slide. It can be
Perfect.
seen, your picture up above it.
Okay.
All right.
So Mike, thanks for the intro. I'm Ben Johnson. I work for a company called CalDRE Inc. We're based in San Francisco. I'll give you a little background on the company in a bit, but wanted to tell you about a little bit about my background as far as my career goes. I started off as a research analyst for CBRE in Vegas in 2006. That's an entry-level job that I did for a year. And then I went over into appraisal in 2007, which ended up being kind of a lucky thing to do because the recession hit, and appraisal was one of the only places in commercial real estate in Vegas at that time where you could still get a paycheck in 2009, 10, and 11. In 2011, I moved out here to the Bay Area and stayed with CBRE, and stayed in the same job, but went to the San Jose office where I did commercial real estate appraisals in Monterey County, Santa Cruz County, and the Bay Area, and then moved to the CBRE's Walnut Creek office in 2013, where I covered the Central Valley and Solano County, where I live now with my family. And then in 2016, I went over into commercial lending. I worked for a company called Berry Slatt Mortgage, which is now called Slatt Capital, great company, and worked out of the Walnut Creek office a couple of days a week, and then 3 days in their San Francisco office. And then in 2018, 4 of us that are still on the same team moved over to what was then known as Newmark Realty Capital. In 2019, we changed our name to CalDRE Inc. So if you've seen the name Newmark Realty Capital, we're now called CalDRE. So my cell number and my email address are there as well, if you need those. I want to tell you a little bit about our company. In 2020, or well, let me back up a little bit. The company is headquartered in San Francisco, but has offices in Seattle and Eastern Washington, Portland, LA, Orange County, Phoenix, Las Vegas, and all the way across the country in upstate New York. We've got about 100 people, about 60 of which are commercial mortgage brokers. 2020 was not as big a year as we had projected, but we originated about $3 billion in loans in 2020, and closed over 400 loans. There's a breakout of which types of properties we did the loans on there. A lot of apartments, industrial, office, self-storage, retail, and then some other. Our company has 2 business lines really. One, our main business line is brokering commercial mortgages and originating those loans, and then we also service loans for the life insurance companies that we do loans with. So when we sign up a loan with a life insurance company and get it closed, that goes into our servicing portfolio. So we currently service $17 billion in loans that is spread out through 2,000 different individual loans. I won't go into this slide too much. This just shows you some of the lenders that we represent on an exclusive basis or semi-exclusive basis in various markets. And these are pretty much, well, a lot of these are life insurance companies. So if we have a client come to us that needs a commercial loan and we end up doing a life insurance company loan for them with one of these lenders, we end up servicing that loan. It goes into the servicing portfolio. And so there's a smooth transition between the borrower getting the loan closed and going into the post-closing and servicing phase of the loan. I also won't go into this, but you can look through this slide later if you want to see what our typical production is. It used to be between $2.5 and $3 billion, but we've made a couple of acquisitions in the last few years that has pushed our production to over $3 billion a year, and we expect to be at that level or higher over the next few years. Before I get into this, let me go back to the last one. I wanted to tell you about the team that I'm on. I'm on a team with 3 other people. The 3 other people are all full-time mortgage brokers. I basically wear 2 hats. On the one hand, I underwrite, process, and close the loans that these 3 mortgage brokers originate. And then I also have my own book of business and do my own production as well. So that's the second hat. We can lend on any commercial property throughout the United States. So right now we're working on loans in a number of different states, many of which are back east. And as far as property types, we do industrial, office, retail, apartments. By apartments, I mean 5 residential units or more, land, mixed use, special use, and then a variety of different loan products, from conventional loans to SBA, traditional conventional bank owner-user loans, bridge, private money, construction, mezzanine, preferred equity, you name it. We can do any of those. Our team of four producers, we closed 65 loans last year, and our average loan size was about 2.8 million. In prior years, it's been, between $4 and $5 million bucks, but we did a number of smaller loans last year. Smallest loan that we closed was $430,000, and the largest loan that we closed was $19.8 million. Generally, we play in the 1 million to 20 million space, but we frequently work on loans that are smaller than $1 million. Our typical clients are family offices or residential and apartment investors who are getting into buying commercial properties. So they've owned a 10-unit property on the peninsula. They've just sold it. They're in a 1031 exchange, and they're buying a Walgreens in Iowa, and don't have a lending source to make a loan to them on the Walgreens in Iowa, and so they contact us. Those are kind of our typical borrowers. We also do a fair number of owner-user loans for small business owners looking to refinance the building that they're in already, or looking to finance a building that they're purchasing. So let me give you an example of some of the loans that we've closed or have been working on during the last in the recent past. The first one there, this apartment property in LA, was just a rate and term refinance where the borrower had kind of a high interest rate through their bank, and we did that one with a life insurance company. 30-year amortization, 5-year fixed at an interest rate that was lower than 3%. So one of the lowest interest rates we've done for commercial. The next one to the right is a net lease Dollar General in Tennessee. Small loan, $430,000. The borrower was using it to purchase the building. 3.3% interest rate on a 10-year fix with a 25-year amortization. This one to the right of that is an owner-user early education property that was a vacant building purchased by an early education small business, and they were going to open up another school for pre-kindergarten kids there, and so we did an SBA 7A loan for them to buy that building. Bottom left is a flagged hotel in Silicon Valley, low leverage. That one was ended up being an interest rate around 3%, which is exceptional for a hotel. It's not something we could replicate now because it closed before the pandemic. To the right is a Walgreens in the Central Valley that I'm working on right now. That's a 10-year fixed with a 30-year amortization at about 3.5%. And then finally, bottom right is one that I'm working on now. It's a ground-up apartment construction loan in the Central Valley. where the borrower between the regional bank that's providing the first mortgage and the mezzanine lender is trying to obtain total financing of about 39 million. So that's kind of a sampling of the types of deals that we're working on. I assume that well, let me pause here for a second. I'm going to go through a couple of more topics, and then I can open it up for questions. I hope that's the best way to handle potential questions. But I thought it might be useful for those of you who haven't been involved with commercial loans before, at least not directly, to see some of the unique characteristics of a commercial loan. And what I'm using as a frame of reference are residential loans. I assume that most of the people on the call are familiar with the residential loan process, either through refinancing their home or having a client going through the refinance or purchase loan process. So I wanted to compare and contrast the two. The first row there is focus. You know, with residential loans, the focus is usually not on the collateral so much, because there's a lot of uniformity with loans or uniformity with residential properties. If you go into, you know, a neighborhood of tract homes in Southern California, there isn't a tremendous amount of difference between one home, let's say built by KB Homes, and the home next to it built by KB Homes in the same year. So the focus is on, you know, the borrower's credit score and their liquidity and their income and debt to income ratios and things like that. With commercial loans, the focus is more on the property. Properties tend to be very unique, and there's more of a magnifying glass on the property itself, with some emphasis on the borrower and their financial strength as well. Closing costs. With residential loans, sometimes, you know, the lender will cover various closing costs, and those closing costs may or may not be visible to the borrower. With commercial loans, the lender does not cover really. It's rare for the lender to cover any of the closing costs, and the costs are highly visible to the borrower, usually just, you know, as a separate row on the settlement statement. And you know, one way or another, the borrower is paying the closing costs, whether it's, you know, with a residential loan, sometimes the way the lender is able to cover some closing costs is by adding 5 basis points to the rate. In commercial lending, the interest rate is what the interest rate is, and the lender's not going to cover closing costs, but they're also not going to add 5 or 10 basis points to the interest rate for the fact that they are covering closing costs, if that makes sense. Interest rate range for residential loans, it's fairly narrow. You know, right now you can get a fixed rate that's under 3% on a home in the Bay Area for a qualifying mortgage. The default rates on single family residences where the borrower lives in the home are very low, and that's why rates for residential loans are also low, comparatively speaking. There's a huge range of potential interest rates for commercial properties. We have done some loans that are below 3%, but we've also closed a loan at 10%, a hard money loan on a vacant building that had to close in a week. So depending on the risk of the loan, the interest rate can be really high, but generally speaking, interest rates for commercial properties tend to be higher than for residential properties. There's a number of loans we're working on right now that are right around 4%. And for a first-time commercial borrower, that might seem kind of high, but the default rates on commercial properties are higher than for residential ones, and that's reflected in the higher rates. Now, having said all that, for really down the middle commercial loans that are higher than $1 million, low LTV, industrial or apartments, you can still get an interest rate below 3% right now, which historically speaking is amazing. Fixed interest rate periods with residential loans, you know, it's not uncommon to get a 10, you know, 15, 30-year fixed. Most commercial loans are a 5-year fixed, a 7-year fixed, or a 10-year fixed. You can get a longer than a 10-year fixed, but you'd have to go, for the most part, you'd have to go to a non-bank lender. So a life insurance company, or a lender like that. So it's a little bit more rare to see the long-term fixed, ultra long-term money for commercial deals. Heavy lift document requests. By this I mean documents that have to be created from scratch by the borrower or by somebody on the borrower's team, their accountant or their consultant or whatever, or property manager. With residential loans, that you don't see requests like that very often. I just finished refinancing our house, and everything was easy to put together. It didn't take me more than a few minutes. With commercial loans, there are some document requests that do require some time. I'll give you an example. We're doing a loan on a multi-tenant property, and the borrowing entity is an LLC. Our borrower is the only member of the LLC. He owns it. So the financials pretty much just flow through his personal tax returns. Well, the lender needs a balance sheet and a 2020 year-end profit and loss statement for the LLC. He's going to have to create that from scratch, or his accountant will have to create it from scratch. And that'll take some time. So we do see that in commercial loans. Do you need a team a team of people to close a residential loan? No. The borrower can pretty much handle any request that comes across, comes through their email. With commercial loans, it is helpful to have somebody helping the borrower along the way. Of course, I'm going to say that because we're a commercial mortgage brokerage, and it is part of the job to help commercial borrowers. But it is helpful to have a team to help the borrower get a commercial loan closed. But we have seen lone wolves close them, provided they're willing to put in the work. Personal credit decisions. While you're refinancing your house, you probably shouldn't make any open up a whole bunch of new lines of credit, or make that big purchase or deplete your cash or anything like that, because the lender's monitoring that stuff. With commercial loans, or the lender's not really monitoring that stuff. They look at a snapshot of your financial strength as a borrower at one point in time, and then they move on. And finally, closing time frame. You can get a residential loan closed in fewer than 30 days. It's possible. It frequently happens. With commercial loans, there are some specialized types of loans you could close in fewer than 30 days, like private money or hard money or bridge loans. But typically, it's more like 35 to 60 days. If you've got a borrower who doesn't quickly provide information, or it's a really hairy SBA loan, then it can take longer than 60 days to close. And that's something that has been a big surprise to borrowers doing their first commercial loan, and oftentimes to the representatives or agents of those borrowers. And then I wanted to talk about SBA loans. There are two SBA loan products that can be used for commercial properties. One is the 504 loan. It's used to purchase real estate only. So if there is a business component to the acquisition, then you wouldn't be able to use a 504 for the most part. It would probably end up being a 7A loan. The borrower must own or occupy at least 50% of the building. So it can be multi-tenant as long as the borrower's business is in at least 50% or more of the net rentable area. The borrower can borrow up to 90% of the value, which is very high. Your conventional commercial loan typically has a max LTV from 65 to 75% LTV. So to be able to borrow up to 90%, it is high leverage in the commercial world. There are two parts to the SBA 504 loan. One is a first mortgage, where you've got a traditional lender that's in the first position, and that lender is running their once the loan starts, they do their typical loan process. They send their typical forms out to the borrower, order the third-party reports, go through their typical approval process, go through their typical closing process. Usually that first mortgage is at 50% LTV. Then there's a second mortgage that is administered by what's called a CDC, which is that's short for Certified Development Company. The Certified Development Company is not lending out their own money. They're lending out money that comes from other private sources, but they are the entity that ends up submitting the loan for approval to the SBA. So that's their role. The CDC, and what is typical is for the CDC to be working on the second mortgage, which is up to 40% LTV. So you typically have a first mortgage that's 50% LTV with a traditional lender, a second mortgage at up to 40% LTV, and that's where I get the total leverage of 90%. The CDC has their own process, and their process is to gather the documents and forms and underwriting items that the SBA will need to see. And so you've got those two parallel processes going on, your typical traditional lender process and then the CDC process at the same time. That can make for a lot of emails and communication for the borrower. And so that's just something to keep in mind. What the borrower ends up with at the closing is a blended interest rate. So I'll give you an example. Let's say that the first mortgage administered by the traditional lender is at 4% on a 5-year fixed. The second mortgage is at an interest rate determined by the SBA. And those rates right now are extremely low. The second mortgage that is processed by the CDC, I mean, the borrower could get a 20-year fixed for about 2.21% right now, or a 25-year fixed, ultra long-term fixed rate for 2.26%. So to use that example, if the traditional lender did a first mortgage at 4% and the CDC processed a second mortgage at 2.26%, on a blended basis, the borrower ends up with an interest rate at 90% LTV of 3.04%, which is really, really, really good in the commercial world. So that's the 504 loan. The 7A loan is a more flexible product. It can be used to purchase a property where what is being bought is land, building, and a business. It can also be used to provide a loan to a business where the business doesn't own the property that they're in. So I did an SBA 7A loan one time for a borrower who's a tenant in a building, and he wanted to pay off some equipment loans he had. He wanted to borrow $850,000 for that. So he didn't even own the building. We got him the $850,000 loan through the 7A program. One thing that's important about the 7A program, it can be based on projected income and expenses for the business, that the borrower's business. So that is not typical of commercial owner-user lending. For the most part, when a lender is just doing a conventional loan to an owner-user who's buying their own building, they're just looking at the historical cash flow for the business, and that's what the loan is based on, or that's a part of the loan approval process. With the 7A loan, the loan can be made based on what the borrower expects their business to do in terms of income and net cash flow over the next few years. So it's easier to get a loan like that approved than it would be a conventional owner-user loan. It can go up to 90% LTV. There's a single interest rate that is quoted. It's not quoted as two separate rates. And the rates tend to be higher for the 7A program because I think the defaults are a bit higher. Usually, the interest rate is a spread over the prime rate. So the prime rate's 3.25% right now. If you add 100 basis points to that, so 4.25, that's kind of your low end of the range for a 7A loan. And the high end of the range would be 250 basis points over prime, so 5.75%. So kind of higher rates, but a lot more flexibility in the product. There's a traditional lender running the loan. There's a CDC involved as well. So same with the 504 loan, a fair amount of documentation required for those. And then the last slide I wanted to go over here is just a continuation of some of the unique features or interesting features of SBA loans. It's these SBA loans have a complex structure. Even though the loans are being offered and closed for people who are often doing their first commercial loan. I'll give you an example. So when the loan closes, the loan is not totally done. Basically, the lender who was in the traditional lender that was in the first position for the 504 or running the loan process for the 7A, they hold on to the loan and keep it on their books. And there's something that is called an SBA debenture that occurs later on, where the loan is sold to a private investor, and the private investor is guaranteed to get interest payments twice a year. Well, to get the SBA loan from the closing, where it's sitting on the lender's balance sheet, to the debenture process, a bridge loan is needed. And the bridge loan is made to the borrower without the borrower having to do much, but there is a bridge loan going on there. So that's a fairly complex thing. Now, SBA lenders are not dumb, and they know that most borrowers would not want to, process a typical bridge loan, so they make it easy on the borrowers as far as that goes. But that's something to keep in mind. These SBA loans can have high closing costs compared to conventional options, but there is an offset to that, which I'll mention in a moment. A lot of documentation is required for an SBA loan, and that's because there's a government entity involved. The SBA is guaranteeing 85% of the loan amount. And so anytime there's a government department involved, there's going to be, every T has to be crossed and every I dotted. High leverage, as I mentioned earlier, you can go up to 90% LTV on many of these SBA loans. The SBA charges a 2.65% fee applied to the loan amount. That's called the SBA guarantee fee. And on $1 million loan, that's a lot of money. It's over $25,000. Thankfully, right now the SBA, and this is a function of the pandemic, but the SBA has some promotions going. They will waive the guarantee fee for loans closing, I believe, before the end of September 2021. And also, the SBA is making the first 6 mortgage payments for borrowers closing SBA loans before the cutoff in September of this year. So I recently worked on an SBA loan where the borrower was going to save $28,000 on the SBA guarantee fee being waived, and another $39,000 because the SBA is making their first 6 mortgage payments. The last thing I want to mention about SBA loans is that the SBA loan mill is always going, unlike other capital sources. Back in March and April and May of 2021, a lot of banks stopped making commercial real estate loans. A number of other commercial lenders just hit pause until they could wrap their arms around what was going on with the pandemic. The SBA did not do that. They continued to originate loans last year. In fact, the SBA put out a huge amount of money last year, higher than most of the years that the SBA lending program has been in existence. It was a huge year for SBA loans because the rates that I mentioned earlier for the 504 program are so low. They're well below 3%, and so a lot of SBA borrowers wanted to take advantage of those low rates. So that's the material that I have. I'd like to open things up to questions here if any of you have questions about something that I've covered or something that I didn't cover.
All right, cool. Thanks a lot for that. I have a question about the SBA loans.
Sure.
Lawana and I have another escrow in San Leandro, commercial property, similar to the one that you worked on before. Remember the one on Washington? And
Sure.
The buyer is doing an SBA loan. The property has a non-conforming use, which is past the grandfather period. And the question really has to do with how long does it take to close one of these? Because it's been dragging. I mean, I'm talking about more than a month in the processing since the buyer has said that they're working on the SBA loan. I'm concerned that that's going way past what would be normal. How long would it take to close one of those loans? It's going to require some construction. It's rolled into the SBA loan process.
How long would it take to close an SBA loan that where the property being purchased has a non-conformance issue?
Right, and then there would have to be work done, obviously, in order to end up with something that the city will allow.
Right. What the SBA will want to see is some communication from the city that says that the borrower's intended use of the property can be allowed really from day one after the closing. The SBA doesn't want there to be a period of time after the closing when the borrower might not be able to use the property for their intended use. That's one unfortunate aspect of the SBA loans is that, because the SBA is a federal government entity, they want to make sure that the local municipality that has jurisdiction over the property says that the borrower can use the property for the intended use on the day after the day of the closing, basically. So as for the timing of the closing, it'll depend upon when the city of San Leandro says, yes, you can go ahead and use yes, Mr. or Mrs. Buyer, you can use the property for the use that you intend to, and you don't have to wait a month or two after the closing. You can do it immediately after the closing.
So if construction work, if work needed to be done, because the city says work needs to be done, the property needs to be modified, right? They are not going to, I've spoken with them, allow it to be used the way it is currently. From what I'm hearing is that the SBA isn't going to lend on that, right? So the construction would have to be done first to bring it up to a conforming use before the SBA would fund.
Yeah, and unless the municipality will provide some sort of bridge to getting a long-term approval of the use. So if the municipality issued, let's say a temporary certificate of occupancy or something, or not a certificate of occupancy, but a temporary permit that said, until you get this work done, you can. We know that you're getting this work done, and ultimately we plan on issuing a certificate of occupancy or whatever the necessary document it is once you get the work done. But here's something to get you through until that point.
Yeah.
Unless the city was willing to do something like that, I think the SBA probably wouldn't land on a property like that.
Yeah, I'm starting to get that feeling because the agent isn't replying to us. The city has said it would have to go to a hearing because it would be a change of the use, and it was grandfathered in, but it's no longer grandfathered in. And so what I'm hearing, they're not going to be able to get an SBA loan to do that. Is that
Yeah, I'll give you a quick example here. So, I had a buyer under contract on an older standalone single occupant building that was vacant, and she planned to run her business, her commercial business, out of the space, and the property had no on-site parking, and it hadn't been used by the seller in more than 6 months. And the municipality's requirement was, if you don't have on-site parking, it's not the end of the world, provided that the use that the buyer is intending to use the property for has been the use of the property, active use of the property within the past 6 months. Well, the building hadn't been used for the past 6 months, had been sitting vacant. So the city would not let her buy the property and use it for her business on day one. And we ended up not being able to get an SBA loan on that property. I wish that things like that didn't happen, but it did on that one.
Yeah, that's a similar circumstance to what we have.
Yeah.
It's way more than 6 months. Is there, once you're in an SBA loan, and is there like any kind of a prepayment penalty? Can you refinance it, change your mind afterwards?
You can. There is a prepayment penalty. It's not the most onerous prepayment penalty. On an SBA 504 loan, what that prepayment penalty is determined by the primary lender. So it's pretty common to see what's called a step down, which means that if you pay the loan off or refinance it in year one, the penalty would be a percentage of the principal balance that's outstanding. Usually, a common number is 5% of the principal balance. And then that penalty drops to 4% in year 2, 3% in year 3, 2% in year 4, and 1% in year 5. It's a pretty common structure. So there usually is a prepayment penalty, but it's uncommon to see there be a prepayment penalty after about 5 years. Those usually burn off. What I would say is that it's pretty unusual to see a borrower refinance an SBA loan with another SBA loan. What usually happens, because the SBA component on the 504 product is ultra long-term fixed and is a good rate. Like right now, on a 504 loan, the 40% LTV second mortgage could be as low as 2.21%. Borrowers tend to just hold on to those loans. They hold on to them, and they know it'd be hard to replicate a rate like that in the conventional market. Now, if there's a borrower that has a conventional loan at a high interest rate, you could refinance that with an SBA loan to get a lower rate. So I happen to be working on an office condo refinance right now in San Francisco. The borrower operates his business out of the office condo. He has a loan through his bank at 6%, which is not a good rate. And he wants to refinance out of that and get a lower rate through the SBA 504 program. So the bank that's doing the 50% part of the loan they're at about 4.15% on a 7-year fixed, and then the SBA, the CDC part, the second mortgage at 40%, is below 3%. So on a blended basis, he's going to get an interest rate that's in the 3s, which is over 200 basis points lower than what he's paying his bank right now. So you can do something like that. You can refinance a bad conventional loan with an SBA loan.
Cool. You may have said this. What is the maximum loan amount for SBA?
$5 million.
Yeah.
There are some industries, if the borrower's business is in a certain industry, there's an internal exception that can be made to go up to 5.5 million. So if your borrower's business is like manufacturing solar panels or running a wind farm or something like that, that is related to, green energy or renewable energy sources, and they can borrow up to 5.5 million. One thing that's interesting is lenders can do SBA loans on construction projects. I have a client that is planning on building a hotel, of all things, in the Bay Area later this year, breaking ground on one. They think that by the time it hits the market in a couple of years, the hospitality sector will have bounced back, and the project is just the right size. So the SBA or the bank is going to do a construction loan at $5 million, and the SBA is going to do the CDC is going to arrange the other $4 million at the interest rate on that is going to end up being in the low fives, which is really good for any construction project, but for a hotel construction project in this environment, it's really competitive. So the SBA can work on construction loans if it's the right size.
What's your take on the commercial real estate market in the Bay Area? Is it crashing, going to improve, getting better?
Well, it depends on the property type. The industrial sector is doing just fine, and the loans made on industrial properties are, for the most part, performing, especially multi-tenant properties. And the higher the population in an area grows, the more places you need to put things and or carry out processes, and that's what industrial buildings can provide. So I would say that the industrial sector is doing just fine. The apartment sector is generally doing fine as well. I mean, there are some apartment properties where the delinquency rates for rental payments are higher than historically they've been. What we've been seeing there is that rent collections for apartment properties are anywhere from 85% to 100%, depending on the property. The office sector is under a lot of pressure right now. The vacancy rate has increased. I think that in certain urban submarkets, the rental rates are going to come down over the next year or two. Our office is on the border of the financial district in Soma in San Francisco, and in that area, I'd expect rental rates to go down, just because so many people are working from home, and so if an office tenant has a lease that's coming up for renewal, they might consider either not renewing the lease or going to a smaller space or something like that. And then hospitality is under a lot of pressure right now as well. I mean, the average occupancy rate at a lot of Bay Area hotels is still under 50%, where historically it's usually 65 to 75. And a lot of loans in the hospitality sector are, some sort of mortgage relief has been requested at some point, and so the hospitality sector is in tough shape right now. Retail is actually not doing that bad. Our team does a lot of retail loans, and you can still get. We can pretty easily find a loan on a retail property in the Bay Area, provided that rent collections are not too bad. So in the long run, the hospitality sector will come back. Retail will come back faster than hospitality. I think a lot of people don't have a lot of visibility when it comes to what's going to happen to office. And I think apartment and multi-tenant industrial properties have always been beloved by lenders, and they're especially beloved by commercial lenders right now.
Yeah. Is there a minimum loan amount on the SBA?
Not that I know of. I think that is really up to whoever the conventional lender is that's running the process. So the SBA doesn't have the capacity or setup to interact with borrowers directly. So all the SBA loan program is administered through banks and credit unions and lenders like that. Those lenders frequently have a minimum loan amount, not so much with the credit unions, but with the banks. And so if the bank's minimum loan amount is, you know, $500,000 and an SBA borrower is looking for less than that, then they might say, no thanks, that's too small for us. But I haven't run into a situation where an SBA borrower has been looking for a loan amount that's just too small. I think the smallest request I've fielded is for $400,000, and we found a home for that one.
Okay. Is the 2.65% guarantee waived through September 30th?
It is, so far as I know. I think it's to encourage small business owners to borrow as the pandemic continues and eventually winds down here. So it's that's a really big deal. I mean, I think it's really painful when you're, you know, buying a building and dealing with other closing costs to have to pay this 2.65% guarantee fee.
What areas, there's a question about, in what areas in the Bay Area are you seeing higher rental delinquency rates?
I'd say in areas where the pandemic has really hit people's income hard. We have a couple of clients who own a portfolio of apartment properties in the East Bay in some really nice neighborhoods, where their tenants, a lot of them work in technology, or they work in an industry where they can pretty easily work from home, and their income the tenant's income hasn't been hit by the pandemic. While we were working on a refinance for those two clients, they had to fill out this COVID questionnaire, which is a pretty common request by commercial lenders right now. And of all the apartments they own, they didn't have a single tenant that had not been able to pay rent. They had 100% collections, and that's because their apartment holdings are in, you know, Point Richmond and Kensington and Albany, and these nice areas where people have jobs where their income has not been impacted by the pandemic. In areas where you have, you know, a lot of apartment tenants who, you know, might be bartenders or servers or you know, have jobs where it's just obvious that their income is going to be way down during the pandemic. Rent collections have been lower in those neighborhoods.
Okay, cool. Well, thank you very much. I see we've reached the 1:30 mark. So I've shared a copy of your slides with everybody, which has your contact information in case they have a client who's really interested in getting a commercial loan. Reach out to Ben, great loan agent. We worked together in the past very successfully. And anyhow, so why don't I think that's it. We're gonna throw in the towel. Thank you very much, Ben. We ought to do this again. And
yeah, anytime.
A lot of fun. Okay.
All right. Thank you, Mike. Thanks, everyone.
Thank you, everybody. Be safe out there.
Thanks.